Well, I certainly think it was a very disappointing number, both on a nominal basis and relative to expectations. But you're right. We do have to look at this in the context of what we saw last month, which was an outsized above 300,000. We know one data point does not make a trend. So smoothing this out and looking at it on a 3-month, as you said, or even a 6-month basis, we see that the pace of job creation has slowed from near 230,000 to 190,000. So yes, the momentum in terms of job creation has slowed, but it's not nearly as dismal as it would be if you focused just on that February report. And of course, there was some one-off implications here from unseasonably cold and wet weather across much of the country that compounded that downward pressure on goods-producing payrolls, or construction specifically. And of course, it wasn't all negative. We did see improvement in the unemployment rate and in wages. But of course, here too, we need to put that in a broader context. Wage gains have really only picked up more recently after years of more lackluster growth. And at this point, they may prove short-lived if we are talking about waning momentum in terms of top-line activity or a possible recession around the corner.
Lindsey, we have had a mixed bag in terms of data here in the U.S. We did have that polar vortex and some of this wonky weather. The government shut down, a number of other factors that could be playing into some of the reports we've gotten, including this one this morning. Could we actually see sustained 3% plus growth in the U.S. like Kudlow is suggesting?
Well, I do think it's going to be difficult to get 3% or above, as he suggested, but I do think we'll maintain positive growth in 2019, but closer to what the Federal Reserve is looking for in terms of a slower pace of positive activity relative to last year. We're looking for growth to come in right around 1.5 to 1.8%, so a noticeable decline, but glass half full, still positive activity for the U.S. going forward. But you're right, the mixed data doesn't suggest solid ground. It suggests still positive, but uneven ground at best for the U.S. economy.
Meanwhile, you got the export data out of China. You got factory orders out of Germany. To what degree does the U.S. economy dovetail with what we know ex-U.S. is doing around the world?
Well, I think this is one of the biggest concerns for policymakers at this point. They've really been pointing to international weakness and geopolitical risks, and they really only care in so much as it extends back here to the U.S. So that contagion factor in terms of reduced global growth translating into a slower demand for goods and services overall, commodities, raw materials. And this is where that concern of importing deflation or disinflationary pressures to the U.S. comes into play. And this is really compounding the Fed's outlook for not only reduced growth, but a slower inflation number here in the U.S. as well. This is a global economy, and the U.S. does have to take into account that we are seeing very reduced output levels overseas. As you mentioned, disappointing growth numbers in Europe, Italy, the latest casualty to recession, the German economy, the largest economy of the bloc, just bouncing along at near zero growth at this point, and of course, the weakest growth profile out of China that we've seen in decades. So this compounds a much more dire or dismal outlook for the global economy, which will have implications here at home.
So in light of those comments you just made, in light of the ECB's 180-degree move yesterday to gear back up for more easing, where does that put the Fed through the rest of this year?
That was a pretty exciting announcement yesterday from the ECB. Now, that type of program wasn't a surprise in and of itself. We've seen the European Central Bank take that type of bank lending program before, but the timing was shocking. Generally, they give a substantial lead time to the market to begin to acknowledge the fact that additional stimulus is coming down the pipeline. So really sending a signal of emergency or a sense of immediacy. Now, in terms of the Fed, this is likely to compound the need for patience. The Fed feeling very comfortable in their position on the sideline, bypassing the March meeting with a near probability of 90%, no additional rate hikes this year. And at this point, if we do continue to see some of that weakness, as we expect, bubbling underneath the surface, become more evident in the data, the next move from the Fed is likely to be to the downside, potentially as early as the end of this year.